Welcome back. Today topic is risk management and how to manage risk in investment. Understanding this is very important, and so is managing risk. As we all know, any investment is always a very risky affair. Therefore, understanding in totality, giving a due weightage, and managing risk becomes paramount towards overall gain in any equity investment. Not only in equity investment, in any investment, because whichever investment you pick up, it has the associated risk and return. It is said, higher the risk, higher the return. So the question comes, where to stop, which one to choose, so that we really optimize on the risk return trade-off. So friends, let's move forward and discuss all these aspects. Understanding and managing risk. First, what I'll do is I'll just pick up a dictionary meaning of risk. When you look at when a word like risk comes in front of us, what is the meaning? Normally, a general public associate with the risk. The Oxford Dictionary defines risk as a possibility of something dangerous or unpleasant happening, a situation that could be dangerous or have a bad result. If you look at this definition, one thing comes up very clearly: the outcome of an event or outcome of an endeavor is not in line with what we are expecting. If that be the case, we call it a risk. This means something dangerous or unpleasant. This means something which we are not looking towards, which is not we are looking for, and we come across that. Take a simple example, even crossing a road. When we cross a road, and particularly in a traffic like Mumbai traffic, crossing road is always dangerous. You might get to an accident, break your legs, or who knows, some serious accident might happen. So even a simple activity like crossing the road is risky. Similarly, in relationship, if you look at, even getting married could be a risky affair. And you know, persons like Bill Gates, at the end of the journey, so many years if they are parting. So when you look from a pure perspective of retaining these and then looking in long term, these all affairs are risky. So is the case with stock investment. Whatever you do, whichever type of investment you take, be it a fixed deposit, be it a company deposit, bonds, stock, all of them are risky. The degree of risk associated with them are different. Therefore, depending on our risk profile, we need to really look at which suits our profile the best and how we can optimize that. So when you talk in terms of investment, all investment involves some degree of risk. In finance, it refers to the degree of uncertainty or potential financial loss inherent in an investment decision. So this means when you take an investment decision, there is a risk associated. So how much is the risk? How much is the probability? That is what is known as risk. Typically, risk is computed as sigma or standard deviation of the all possible outcomes. And statistically, that we call risk. So let us say you are investing in a stock and chances of getting different returns are enumerated. When you calculate the standard deviation of those outcomes, chances, that will give you the risk profile of this investment. Now the question comes, how to really maximize that or how to really use it to our advantage. There are certain ways you can always use to mitigate risk, although it may be almost impossible to eliminate risk completely, but you can always use certain ways to mitigate risk. Some key points in the risk management or understanding and managing risks are: one is risk profiling. Each individual has a risk profile, and risk profile means like someone likes bungee jumping. Not everybody likes bungee jumping. The one who is risk takers, they really enjoy bungee jumping. So because it may cause your life as well. So from that perspective, it doesn't mean that if you are not a risk taker, you are not a good person. No, there could be risk taker, risk averse, or risk neutral. All three personalities are required at different point in time. So the question here is, if you understand your risk profile, then you can design your portfolio to suit your risk profile. Therefore, risk profile for person A may not be the same as risk profile for person B. So the answer is clear. When you choose a portfolio, Choose one which matches your risk profile. Risk profile is a function of, or it could be impacted by your age. In early age, people can take higher risk because he has whole life to regain even though something unusual happens. It also depends on how much wealth you have, who are the earning members, what are the liabilities in front of you. All those points impact risk-taking ability, risk profiling. One thing I like to reiterate here, there's nothing like a good profile or bad profile. There is a profile. So it is important to understand what is my profile without thinking about what is a good profile or what is a bad profile. There's nothing of that type. Having understood risk profiling, the second is you can reduce stock investment risk by following a principle known as diversification. It is said that you should never put all eggs in the same basket. This means even though the company is great, you never know what happens with the group, something happens with the industry or the country. Therefore, here in stock, there are two types of risk. One is systematic, other is unsystematic. Systematic risk is known as market risk. So whole market goes in a particular way. Whole market is rising, and along with that, all shares are rising. That is called systematic risk. So the coefficient or the ratio with which a company moves with the market is known as systematic risk of that particular company. And it is very hard to eliminate that. Unsystematic is risk associated with a particular script or particular investment. And that can be mitigated by diversification. Normally, theoretically, it is said that if you buy 8 to 10 stocks coming from different industry segment, you are good in terms of diversifying your risk. So normally, you can go up to 15, 20 also, but ideal could be about 10, 12 stocks, which is very hard to get because when you start investing, temptations and greed, these keep on maneuvering on you, these keep on controlling you, and you tend to bring more and more stocks in your portfolio. Therefore, not only you achieve the diversification goal, but you go much beyond, which becomes damaging to your portfolio. The second one is asset allocation. What it means here is there are different asset classes like real estate, gold, there could be bonds, stocks, company debenture, foreign equity, and many more. Each one of them has got same systematic and unsystematic risk. So therefore, not only you diversify your investment in a stock, but also you diversify across different asset class. This means if you have $1 million to invest, then you have something in your real estate, something in equity, something in bond, something in fixed deposit, and something in gold. And this proportion will depend precisely on your risk profile. Your profile, which we can tell you using a questionnaire. You answer certain questions, and that helps the analyst to project your risk profiling and suggest you, look, you are a risk taker or average risk taker or risk averse type of individual. Therefore, to suit your condition, to suit your needs, this will be a good risk profile. So that is what we call asset allocation. Now, these are some of the theory which helps you controlling your risk. But there are certain things which you must exercise. I would repeat, this list which I am going to bring to you, you must do so that you can reduce the chances of losing money. It is your hard-earned money and nobody should lose the money. Even a single penny of whatever you have earned, sweating day in, day out. Warren Buffett has said, he said there are 2 rules for investment. One is never lose money. Second rule is never forget rule number 1. So one thing you must keep in mind, before you invest, you must look at different analysis. You must look at pros and cons. You should try estimating what might happen with the price. Once you decide to invest in an equity, your endeavor should be not to get panic and sell in panic, because that always will keep on eroding your capital, which is not good. So very first thing is have liquidity. You know, we are all very much used to the sale. We keep on looking for Dasara sale on Amazon and Flipkart, because there, that time we find a very good discount. Similarly, sale happens in different brands also. Now, friends, do you know, sometime even the stock market has got a sale. But only difference is, we know that every year in Dasara, Amazon will bring a sale. But stock market sale is random. It cannot be predicted when sale is going to take place. And imagine if you want to buy something which is available at 70% discount to its value and you don't have money. So therefore, if you want to be a matured investor, you want to really get a lot out of your investment, you must keep X amount as the liquidity. Could be an FD or a liquid fund or something. Could be 10% of your investment or 15%. Once again, that depends on your risk profiling and investment strategy. But my personal feeling is some amount of money should be kept for buying in a stress condition, that is in sale, a stock sale, which happens when the market falls on certain news. Second is long-term view. Normally, if you take a long-term view, your risk can be reduced a lot. What it means is, let us say you have a day trader who just chooses 1 day duration for trading. This means he invests and then wants to make a gain or loss in a single day. Compared to one which is a swing trader who invests on the dynamics of the market and its duration is a little longer. And third category could be a person who invests for 10 years. So obviously, for a day trader, the riskiness or sigma will be very high. Swing trader will be in middle. And for a long-term trader, a long-term investor, it will always be low. Therefore, Warren Buffett says, the stock market is a mechanism where money moves from impatient to patient. Now, when you look at it, impatient means what? The one who is impatient for making money. Friends, it is not a lottery. And even in lottery, you have chance. So you can't make money in a single day, and don't go with that mind. Because you will burn your fingers. Therefore, once you choose it, be very cautious in terms of choosing the stock. But once you choose a stock, remain invested for a long time. That is the best way of compounding your money. That is what is going to give you the right return. Long-term view, propagation is my mission. And therefore, for corporate professionals or for anyone who has got a 8 to 5 job or 9 to 5 job, trading on a daily basis is not desirable. Because not only you will involve yourself and neglect your job, but your blood pressure will keep on going and coming down. So in that case, the whole idea of investment is to secure yourself for future. So don't get into a thing which makes you insecure today itself. And something is insecure today itself, what to talk about the future. So the next one is due diligence. Now due diligence is very, very important and you must do it. In my videos, I have been talking that decide some criteria for the selection of a stock. Like normally some of the criteria which I take, ROC and ROE should be greater than equal to 15%. Normally, I'll avoid investing in any stock where ROE is less than 15%. Banks, you may have to have different criteria, but these are for general stocks. Similarly, you can talk about NPM and OPM, operating profit margin or EBITDA margin or net profit margin. You can set up a criteria. You can say that X percentage is important. Then you can talk in terms of sales growth. Normally, I avoid investing in a stock where year after year sale is not growing by 10%. So minimum sales growth, I choose as a criteria 10% plus. Similarly, profit growth you can put as a criteria. Now, in terms of debt equity, it is good to have those companies in your portfolio which has got zero or near zero debt. Look at what is happening with Adani. Huge debt. Although he has not taken all debts from India, but on books of his group here around 2,50,000 crore debt. And with Hindenburg report, all of them are collapsing. So it is always good to be away from highly leveraged or those companies which has got a very huge amount of debt. Then, besides this, we also do some valuation criteria. Like I look at 5 years median PE, 3 years median PE and 1 year's median PE. And PE today, I normally prefer it should be lower than all 5 years, 3 years, 1 year. You can also look at if there is a trend in PE, like whether PE has been sort of like ran a lot in the recent time. This means the stock has gone through a lot of hype cycle and chances of those stock growing becomes less. And similarly, you can look at the PB criteria. Again, 5 years, 3 years and 1. Ideally, you choose a stock where P as well as PB, they are lower than the median on 5 years, 3 years and 1 year term. That will help you eliminating a lot of things. See, brokers, new channel, they keep on giving you stock on a daily basis. Don't go and blindly follow those. Look at those stocks. Because many times, since we don't have time, we can't do so much of research, we need to listen to the people. Therefore, I'm not saying don't follow them. Follow them. Don't invest blindly what they say. So take those stocks, do your own due diligence, do a little bit of research around it, and then take a call whether you are going to commit some money to this or no. If you do that, your risk can be mitigated to a very large extent. The chances of you losing money will become quite low actually. And having done all these, the next one is monitor your investment. You should not invest. Although Warren Buffett says that we invest and then sleep for 10 years. He says that if stock exchange gets closed for 10 years, I will be happy. Me and you are not of his caliber. Well, ideally, if you have so much of confidence, you can follow him. Theoretically, yes, subject to the capability. But for a human being or common persons like us, it will be a good idea to keep on looking at your stock at least every quarter. Don't keep on looking every day because your day job is more important to you. This is something which you are doing inside. And therefore, but do look at it every quarter. Because today, based on certain criteria or certain assumptions, we have made a statement or investment. Tomorrow, some conditions might change. And that time, it will be time to exit. So what I have talked so far is, one of the basic way of mitigating risk could be investing for long term, doing a due diligence, and then have some liquidity so that you can buy during sale. Here you get sale sometimes more frequently. Sometimes it may come in 2 years, sometimes it comes every 3-4 months. So you don't know when the sale will come, that your liquid money keeps on earning some amount of return, and the sale will really is an opportunity to invest in bulk in a good company, and then you can make tons of money. Zerodha is a zero brokerage company, or the new age brokerage company, and Zerodha co-promoter Nitin Kamath and CEO. Look at his statement. I am surprised that so many are surprised that just 1% of active traders make more than bank fixed deposit over 3 years time frame. Active trading is like running a business. Only a small percentage succeed. Now this has got a great message. I have promoted or I have propagated long-term investment. Now today, when you go to news channel, when you go to the market, when you look at the YouTube, most of the people talk about technical analysis and they talk about momentum. So those guys are day traders. And as you can see here, based on such a huge database, just 1% of them are able to beat the market. Now my question is, if that is the case, which is true, why to make your nights sleepless? Why to unnecessarily take tension? You have a job to do where you need to excel so that you can keep on growing in your life. So therefore, friends, stay away from trading activity. Get into investing. Trading is like more like a speculation. Investing is an art and science. So get into that. And my endeavor is to bring to you knowledge and wisdom in the area of investing. And I myself stay away from trading. Also, I have just got a graph here in terms of if your time frame increases, then how your expected return or riskiness. Look at, if you invest for 1 year, look at this curve. Here the minus and plus is almost 40% and 60%. Like it goes up to 25-30% and minus is about 22%. So chances are, if you look at from 1 year time frame, investment may be negative. As you start moving towards on time frame, you see positive keeps on increasing and negative keeps on declining. So if you have a 10 years time frame, chances of losing money is very little, whereas chance of gaining and huge gain is very high. And this also gives you a effect of compounding. Therefore, friends, it makes a lot of sense to take a long-term investment horizon and do your investment for long term. So today I had discussed about what is risk. It's a probability of losing your money, or probability of not getting what you're looking at, or probability of undesirable result in a very layman language. Now the question comes, it's always probability, and stock market is a risky market. So what to do? So couple of things we talked about. Well, using a stock diversification, you can reduce it. Using asset allocation, you can minimize it. So that these asset classes keep on performing at different point in time. When stock performs, gold doesn't. And when the gold performs, the stock doesn't. So all rich people, all wealthy people, they don't put their assets in single asset class. They diversify. They have real estate, they have gold, they have stock, they have bonds also. So when you look at them, most of them do that. Now, depending on their risk profiling, I also talk about risk profiling, and risk profiling questionnaire will be available in the course, and from there you can find out where you suit. Your profile is where it stands, and accordingly you have to configure your portfolio to suit your risk profiling. Couple of things which you must, and my recommendation is you should never ever forget. What are those? Invest for long term. Don't do a trading. You saw Nitin Kamath's statement. Traders normally lose money. Although the whole market is run on hype, but 99% of the traders are not able to make more than fixed deposit return. So why do you take unnecessary risk and make our night sleepless? So if you want to really beat that, you have to get into investing area. Second is spend a lot of time in selecting a stock. Due diligence is the key. Although I will be talking in different videos and different courses, different criteria which normally are used, but you can choose your own criteria. But ensure once you choose it, use those. Keep on adding on those criteria with your experience, because you will have your own experience. And then without due diligence, you never ever invest. Do diversification, do asset allocation, you will be good. Riskiness gives you excitement as well. So is the stock market. Some people like bungee jumping, water diving deep into water. I do like investing in riskier assets. I don't take so much of risk depending on my age and other factors. But what I can tell you, this is the area which can really make you much happier than any riskier affair or any excitement you may get in your life. So stay tuned and keep on investing. Be cautious in investing. Understand all the concept before you burn your money. And once you understand all the concept, you will never burn your money. The whole journey will be very, very rewarding. If you like this video, please don't forget liking this. Forward this video in your group using social media, WhatsApp, LinkedIn, Facebook. If you are not subscribed to the channel, please do subscribe to the channel. And stay engaged. Do comment on the video. And we thank you so much once again